You're watching Stock Watch this week. I'm Ndawuleng Lechela, and joining me to unpack your stock-related questions today via Zoom is Mutooni from Sanlam Investments and Zwelakhe Mnguni from Benguela Global Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Gents, thanks so much for joining us this afternoon. Before we get into the questions, let's just kick things off with your general reading on markets. We've had a jam-packed week, starting strong with the US-China trade truce, Trump's trip to the Middle East and all the deals that have been struck there. We also had some data coming through, softer in US inflation numbers. Initially, we saw a rally really boosting markets across the globe. That did start pulling back towards the end of the week. Was this just some profit-taking, Roy?
Well, it's like you say, it's been a very interesting week. And I think the first perspective of the rally is that all is forgiven, pretty much, in the sense that we've pulled back from the trade embargo effectively. People are talking. Even India, Pakistan aren't fighting as much.
Yeah.
But in reality, there's an undertone. There's an undertone of softer economy, softer indicators coming through. And again, we're in the world of uncertainty, another 90-day deadline that's been put out. So I think it's a combination of relief that we're not as bad as we thought we would be.
Yeah.
Uncertainty because we've got that 90-day waiting period for the negotiations, and great uncertainty because the soft data that's coming out isn't that positive, but the narrative out of the policymakers in the US is things are still reasonable. We don't expect more than one rate cut. But in the middle of all of these, bond yields are rising. So, yeah, a mishmash, I would say.
A lot happening, Roy, and I mean, you talk about soft data coming through. It was also interesting to see some of these big investment banks already just upping and changing and revising their outlooks on both the US and Chinese economy. Some are even cutting all bets on a US recession. So, like, is it not all too soon? The word Roy used here was uncertainty, and that's really the kind of environment we've been in.
Yeah, darling, I think I agree. I think it would probably be way too soon to be revising numbers up. I think the impact of all these actions cannot be zero. I mean, supply chains have been disrupted and relationships have been damaged. It's not all going to heal in one day and we are able to revise the numbers up. So I'd be very cautious about the numbers that would come through in the next month or so, because the data hasn't fully embedded the impact of the decisions that were made earlier. So I think Q3 for me would be critical as an indicator of where we are going. I do think that the US consumer is under pressure. A relief through a rate cut would be supportive, but I certainly don't think that we are out of trouble as a global economy.
And there's a question here around the US economy. The viewer asks, if the US enters a recession, even though we have seen, those global banks cutting down their bets for a recession, what effect will it have on international equity markets? And how would you structure your portfolio for a US recession? I'll start off with you, Roy.
So I think the way to think about a US recession is the US consumer is a consumer of last resort. That's the economy that's grown, big trade deficit, they import a whole lot. So if the economy starts going backwards, that has repercussions on the rest of the world because the rest of us are small open economies that live on export. So if there's less demand in the US, there'll be less likely that you can grow your production here. So our growth profile gets negatively impacted. So from an equities perspective, clearly earnings growth outlook has to be revised downwards, and especially for cyclically oriented stocks or commodity stocks, those sorts of equities, the outlook becomes dampened over the short to medium term. So that's why we always start these conversations with what's happening in the US, because it draws the rest of the world along. Remember, it's not bipolar. China is still struggling with demand. So if the last place where there's real demand starts slowing down, that means all of us fall into the same problem, because none of us have sufficient domestic demand to carry the production that we have.
You know what I've found really interesting over the past few weeks, few months or so, is the JSE's performance. We've been really holding up while still sitting at that, the all share really still sitting above that 92,000 mark. Yes, we know that the higher gold price has, provided some relief, boosting our gold miners. And I have a viewer here asking about the value in the JSE and which stocks would you pick, the top 3 stocks you'd pick from the JSE. I know our banks are really doing good. Our retailers are also doing good. So I'll give that question to you.
Yeah, I think as you quite correctly pointed out, the JSE's rally has been predominantly premised in the resources area. We've had good performances in the rand hedges as well, and Naspers process if you take a longer dated period. But I think ultimately the resources has been the area where we've seen strong performance. I think if I had to look at the stocks that I could pick, I'd probably go with Shoprite still. I believe that it's a good business that is defensive, in a sector that is defensive through good and bad times. Might be a little stretched at the moment, but I think long term it will unwind that multiple. I think Capitec is a good business. Their exposure to the segment of the market that is underserviced enables them to cherry pick the customers and provide lending to the best customers that they can find. And probably the last, I'd go with Mr. Price. I think it's been beaten down and justifiably so. But I do think that if things don't improve materially from here, it might start regaining some of the market share that it lost during the rally with the GNU optimism.
And let's get your take on that, Roy. And you can't put your stock pick in those top 3 stocks.
Look, the thing, exactly like Zwelakhe says, it's been a story of gold, plats, telcos, that's really rallied since the beginning of the year. And a lot of SA Inc. stocks have sold off considerably. But in the last quarter, a lot of that has reversed. So first quarter of the year, you saw the retailers sell off. Second quarter, they're basically recovering. So you can see a reassessment of outlook. So if I was to make my picks, at the top would be Anheuser-Busch and Richemont. I think Anheuser-Busch gives you good exposure to emerging markets. They're paying down their debt. They're buying back shares. Beer seems to be an early cycle play that's working out. They had sold off. You've seen a significant rally. I still think there's some upside there. Richemont results came out this morning. Their jewelry business remains resilient. They've been able to raise prices in Cartier, in China, and in the rest of the world. So very resilient business, solid balance sheet. It can play into a recovery. And the only one I'll share with Zwelakhe is Capitec. I think Capitec is a business that just continues to boom. It's not purely a bank. It's a platform. They're finding different ways of servicing their clients. They're finding different ways of pushing product through to their clients, and definitely justifies its premium rating.
And let's move back to Richemont for a sec. There's a question that came through about Richemont just on the back of those numbers. As Roy said, the numbers really looking good, really boosted by demand for its jewelry. So this counter has been quite resilient in that luxury market where we've seen those big luxury stocks really suffer as, they're not keeping up when it comes to sale. What's been giving Richemont this edge?
I think the jewelry business is actually quite a strong business. It's a unique offering that is not broadly available. The brochures, whatever you use, that are used by the royal families, they are the target market there, and they are the people that know no recession, no economic difficulty. So that makes it quite resilient. I think the watches, I mean, it's very cyclical, depending on what's happening in China in terms of the consumption in China. China has been weak. Many of their customers there have kind of slowed down the demand. But broadly speaking, it is resilient primarily because of the jewelry business. I mean, they've tried online, which didn't work out, so they're back to their roots again.
And besides Richemont, Roy, where else are you seeing value in that luxury market? Burberry was out with results earlier this week. Really, really disappointing results, but they weren't as bad as markets thought they would be. So we saw that share price shoot up over 15% on the day numbers were out. Is this a counter you've been looking at, or are you looking at perhaps LVMH or Hermès?
Look, I think the one that stands out for me is a lot less liquid, and that's probably Prada.
Okay.
They made a big acquisition recently, so that might depress earnings over the short term. But they've been executing incredibly well. Their Miu Miu platform and product has got very good traction among its core clientele, and they just continue to grow. Their costs are under control. They've got their cost of goods under control, and they seem to know how to execute incredibly well. So that's one that I would definitely look at. The thing about LVMH is it's very broad. So you go all the way from cognac to very high, for very high-end hard goods, and so you can imagine that at any given time there's going to be something that has problems there. So I would stick to the jewelry plays. I would stick to companies like Prada, who are quite focused, who know their end market, who know their end product, and continue to thrive even through periods of uncertainty such as these.
And Zwelakhe, do you think we'll see any real strong growth coming out of those counters when we still see that Chinese consumer under pressure?
I'd probably say that the counters that would be more vulnerable are those that are highly dependent on China. And that's why I say the Richemont segment that is exposed to China would probably continue to struggle. But outside of that, I do think that the market has repriced these stocks quite aggressively. And we may see that prices will rebase at this level, and we may see that they move higher from these levels unless extreme economic outcomes come through. I mean, if a recession comes through, we would have a bigger problem.
Afrimat, the company really had a tough year. Profits down over 8%. Issues, of course, with Lafarge. They're battling with a tough iron ore market as well. The viewer asking here for your medium to long-term view. Zwelakhe, let's kick things off with you.
Yeah, look, I think the original business, I mean, I quite liked it, and it was very neat. But I think their move into cement, I questioned it when it happened, and I think it's going to be a very arduous task to actually execute and turn that business around. So it is very competitive, and there are serious players in the cement market in South Africa who are well established. So they're going to find it very difficult to compete there. But the cyclicality of the original business, I mean, that's to be expected. I think in due course, when the economy is recovered, global economy recover, we'll see some recovery there. But I think in the short term, it will remain under pressure. But long term, I certainly think management is a good team. They've got a very good team that executes there. So I think we would see an improvement over time.
And are you backing that management team? I mean, I spoke to Andries yesterday, and he's sure that, you know, the West is behind them.
So Andries is a proper deal maker. I mean, he's built up this business very astutely, getting assets that nobody else wanted at very attractive prices and putting them together. The one thing is the cyclicality is inherent in each of these, and all their assets are developmental assets. So if you go through a period like we're going through now where commodity prices are down, maybe operating costs are up, or uncertainty in specific minerals is continuing, you will see these problems. So it's never a straight line up. This is the time they'll be tested. They'll be tested properly as a portfolio and as a management team. But I think, yeah, I would back Andries. And if he's made any mistakes, I think he'll be the first one to admit them. and find a way out of them. So I think investing in shares is a long-term game, and that's what the investors in this stock should remember. You did well at one point in time. Trust the management team to get back on track.
And there's a question here on Old Mutual. The viewer has sent it again. I think it came through on Monday when we got the news around the new CEO. The question reads, the share under Trevor Manuel has been on manual gear for long. Isn't it about time for Manuel to be put on automatic or resign? You laughed at that, Zwelakhe, so I'll start off with you.
Look, I think there's definitely been a deterioration in the business operationally. We all remember the issues of governance that were carried in the prior years, and certainly it was under the same leadership. I mean, if there was a suggestion of a change at the board level, I'd certainly support it. I think the business is kind of struggling to find its focus in the market. I mean, nobody knows anymore exactly which market is Old Mutual targeting. I mean, it's too broad and also not executed well. So I'd support an idea of a change in leadership at the board level.
And your take on that, Roy?
So, yeah, Old Mutual is an interesting company. I mean, Jurie Stradom, who's just been appointed to CEO, is an exceptional insurance man. I dealt with him when he was at Imperial Insurance, at Regent Insurance a long time ago, and he's got some fantastic ideas around how to run an insurance company and where to generate value from. And he's young, so he's got almost a clean slate. So if part of that required a change in board outlook and board composition, nothing's wrong with it. I think giving him the reins and the absolute freedom to take this business in a direction would be a big positive. It's not been clear what this business has been doing more recently. They've got some very interesting businesses that they run. So no, absolutely, I'm with Zwelakhe there. We've changed management. Why not change the board as well?
Now let's move over to Dis-Chem. Interesting takes there, gents. Dis-Chem up for analysis as mentioned, and the viewer asks, would you buy a Dis-Chem at these current levels, or are you eyeing something like Clicks? Roy?
So the two of them are very defensive. They play in a market that is rapidly consolidating, and they are the consolidators. So Clicks has kept to its knitting, and what they're doing is opening outlets and trying to get a footprint across the whole country where cannibalization may even happen. Dis-Chem, on the other hand, follows that model and is also doing medical aid and providing services and that sort of thing. And I think there's merit to both business models. What I think is that at this point in time, Clicks has rallied. So from a valuation perspective, probably Dis-Chem offers a little bit more value. But like I said, they're both defensive. During a cyclical upturn, you probably don't want to be in either. Clicks is probably more liquid than Dis-Chem. So if foreigners were ever to come into this market, they'd probably go into Clicks rather than Dis-Chem. So there's a plus and minus for each one of them. At this point in time, I'd probably be looking closer at Dis-Chem.
All right. And Zwelakhe, do you share the same sentiments? Are you going more
I'll
for...
go for Clicks.
Oh, okay.
Safe pair of hands. I don't trust this Dis-Chem story.
All right, gents, let's move over to the property scene. A question here on Equites. The numbers out yesterday, pretty good. They completed a development on 2 facilities for Shoprite, and we spoke about Shoprite and that being one of your picks. So, you know, growth on that end also filtering through to Equites as it continues to build those logistics facilities for the company. If I remember correctly, I think they've signed a 20-year lease with Shoprite. The viewer asks if, you know, to get your take on the prospects for this counter. I'll start off with you, Zwelakhe.
Yeah, I like Equites. I mean, they've executed very, very well. They moved into a niche area of logistics, where many players were focused on office and other areas. So they've done very well in that area. They've built a niche in there. So I think at a 8.5% yield, I mean, I think it's still quite an attractive counter. I'd probably be still a buyer at this level. Hopefully we get rate cuts and they can get some relief on the funding costs, and that would elevate that potentially to higher than 8.5% a yield.
And I think one of their, something that they had in their outlook was to lower their LTV ratio. So those interest rate cuts will benefit them if they do come through. Well, more of them come through. Roy, just your take around Equitas. I mean, I was looking at those numbers and they're practically sitting at no vacancies.
So they're in the right place. Logistics is growth business. Remember, with companies like Amazon, delivery, and all of that, that's fantastic. But they've had some serious questions around quality of earnings. And what is it they capitalize and what is it they expense. So the way they've operated historically makes you feel that they've been optimistic on their earnings, and optimistic on how they interpret their numbers. They're trying to slow down a little bit on that. I still think it's a question, but like I said, they're in the right place. There's a question around the quality of those numbers. That 8% yield, when the long bond yield is at 10 and a half there, it doesn't scream as particularly attractive. So I would be more a holder than a buyer on this one.
Okay. Let's get your general assessment around the property sector. I mean, we spoke about how we're seeing a growing demand in the logistics area. We've also seen, you know, demand recovering in the retail sector as well. What about what's been playing out in the office class? Earlier this week, we saw Dipula Property Fund saying that they're actually seeing a recovery in their office property. Roy, I'll give that one to you.
So I think that is more stock specific. So logistics, no vacancies, good, solid reversions, rental rates rising. It's actually a good industry to be in. Retail, exactly the same thing. Very low vacancies, solid footfall, solid tenants, fantastic business. But in aggregate, when you look at office, you still have significant vacancies, still in the teens. It's very difficult to convert these buildings. There's very little demand for them. Companies had consolidated already, so there's excess supply. I think that is still one that has to turn around, and the turnaround isn't anytime soon. So when you look at a portfolio, you have to see what mix they have of office, retail, and logistics. And in office, you have to have a focus on P grade, so the highest grade that's got all these green certifications or enhancements. Lower end, you probably see substantially greater vacancies, and they're probably not in areas where you want to be.
All right, let's hit pause on the conversation and get to your stock picks as well. Okay, where are you seeing opportunity at the moment?
I'm sticking with Google. I recommended it a while ago, but I remain optimistic about it. I think it is a business that's got lots of sunk costs in R&D to develop things like automotive sector, the flying cars, also they're in the data centers. They certainly have a lot more opportunity to monetize than many other businesses. They're highly dependent on advertising, but they've lagged behind the others in terms of valuation. So I think that it offers a good opportunity at this stage.
And Roy, what are you hanging your hat on today?
I'm a lot more basic than Zwelakhe. I'm picking chicken, so I prefer Astral Chicken. I mean, they had this trading update. The market didn't like it. I think the market didn't read it right. But when I'm looking into the second half and into next year, I've seen that they're getting better chicken prices, better chicken prices, and their raw material costs are actually falling. So when you combine those two, I think there's solid margin support. You've got good top line growth, and you're coming off quite a low valuation. So I think the outlook for Astro over the next 12 months is quite solid.
So Astral for Roy and Google for Zwelakhe. Gents, thanks so much for your time this afternoon. Roy Mutooni is from Sanlam Investments and Zwelakhe Mnguni from Benguela Global Fund Managers. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on Tuesday and Thursday, while Stockwatch this week is live at 12:30 on Fridays. Keep that in mind for your questions. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right on Business Day TV.